This release was from 2015, this interpretation, but it modifies an earlier interpretation from 2012 here. Again, it's very common in the energy markets. And why it's important are forward contracts are not regulated by the CFTC, but swaps and other derivatives are. So if you do a contract with these elements, you want to make sure it's considered a forward contract and not subject to the CFTC's regulation or enforcement, rather than a swap or other type of derivative. And in the original interp, which was 159 pages, they laid out 7 important factors. And then in 2015, they clarified 2 of them additionally. But let's start at the beginning. What exactly are forward contracts with embedded volumetric optionality? Why do they use them in the energy market? And the easiest way to understand this is on the news when they tell you to fill your gas in the car in the morning when it's colder because you get more gas that way. Even if you put in 100,000 gallons when you left Saudi Arabia and you empty the ship, you're going to get less than 100,000 gallons when you get to Toronto. Actually, it's measured in barrels, but you get the point. So how do you deal with that? Well, in your contract, you can specify gross versus net temperature, where when you deliver to the customer, the amount of gas that you deliver to them will depend on, we'll have some adjustment for the temperature. And that technically is a type of this embedded volumetric optionality. And that's generally 2 to 5%. And here's a picture, because everyone loves pictures. So if you took the product out when it's hot and you deliver it when it's cold, and the price is very competitive because it's commodity and it's a few basis points, you might end up losing money on every trade. And whether you win or lose will depend on if you're the buyer or seller and at what temperature you took it out and what temperature it was delivered. So why is this such a big deal? Well, let's say that instead of 2% or 5% of this optionality, it was 100%. Would you enter into that contract? Well, if you think about it, you probably say, well, it depends if I'm the buyer or seller, because at 100%, it is exactly like an option. And if you were selling the option, that wouldn't be great for you. But if you were buying the option, that would be great, because if you're the buyer, you have the right but not the obligation to make or take delivery. But if you're the seller, whether the contract ends favorable to you or not is dependent on the market and the counterparty in a way that doesn't benefit you. So 0% is just a forward, 100% is just an option, and where in the middle this embedded volumetric optionality is, that's the purpose of these 2 CFTC interpretations. And you used to see this a lot more in the 80s and 90s, the Wild West days, with people like Mark Rich. And if you think about it, if you have a sanctioned party like Russia or North Korea or Iran that other people don't want to deal with, and you are willing to do a long-term contract with them, and you're going to give them the same price as everyone else, you have this optionality provision where we're going to do a certain amount, and then I get plus or minus 10% on the oil or whatever other commodity we're dealing in, and then I can find somebody on the other side that will also give me plus or minus 10%. Then even if I'm not making money right now because the oil or natural gas or other commodity is pretty stable, commodities tend to have very sharp price movements when things go wrong. So if prices go up and then you told the person selling to you, you're going to give me an extra 10% according to this contract, and the person you're delivering to, you're going to tell them, I'm going to give you 10% less. So that gives you a 20% swing when you have these extreme price movements, and that can be very profitable. But options are derivatives, and if you don't want that regulated by the CFTC, what do? So in the original 2012 interp, it had these 7 factors, and I won't go into all of them. I'm just going to go into the 2 that were modified by this 2015 interp. This was issued by Elise and Mark Pfeiffer at the CFTC and a couple of people at the SEC. And there were a couple of people on the original one, David Aaron and Julian Hammer, who were not on this one because they had already left the CFTC by that time. But as I said, this just puts some clarity on that. So basically with the underlying 7 elements, There has always been an understanding that commercial parties should be able to do these contracts without having to do it on a regulated an exchange or through the CFTC's rules, and that began with the so-called Brent interp. And if you go through the history of the interps up till this 2012 interp, the gist of it is that if you are a commercial party who was able to make and take delivery, that is who forwards are for. If you are a investment bank or hedge fund and you're just trying to make money on the price movements, but you don't have the ability to make delivery, you don't have the ability to take delivery, forwards are not something that you should be doing unless you're doing actual trading on an exchange of futures or options or swaps that are subject to the CFTC's jurisdiction. Forwards are intended for commercial parties, people who are in the biz and have the ability to make and take delivery. And so with regard to especially this factor number 7, how do you make sure that people who are in the business are not using this as a way to engage in derivatives that are not subject to the CFTC's jurisdiction? So with regard to the 4th and 5th elements, it's still okay to have bandwidth, aka swing contracts. So what does that mean? There's times when you know you're going to need the commodity, but you don't know exactly how much. So for instance, if you are generating electricity and there's a heat wave in the summer, you're going to need a lot more natural gas to make that electricity. So you know you're going to need it, but you don't know exactly how much. So your contract might say that you will agree to buy X amount plus or minus 10%. And that's the embedded volumetric optionality. And whether you need that or not is dependent on what's going on with factors that are physical and not outside your control, like the heat wave, and it is not related to price movements in the market. So you shouldn't be able to use that to take advantage of a sharp price up or down. But if there's some physical factor, like a heat wave, like a tornado, that causes increased or decreased demand that is out of your control, that's what that embedded volumetric optionality is for. It's not intended to be a trading vehicle. And what's also important, and this is consistent with the window forward contract interp that the CFTC issued with regard to Forex, is that you can vary the amount of product that you're receiving based on certain factors. You can also vary the delivery window, but delivery should occur because, as I said, this is a mechanism for entering into contracts for people who are in the business and have the ability to make and take delivery. And the forward contract, that should be the intention. It shouldn't be a trading vehicle. It should be a vehicle for you to match supply and demand. Are there other ways you can do the same thing? Sure. So this is Venture Global. It's a liquefied natural gas production facility. And obviously, as I said, the temperature and pressure and things like that can affect the amount of natural gas you put into a ship versus take out of the ship. But is there another way they can take advantage of the optionality in big price swings without violating this embedded volumetric optionality clause, because you are wanting to trade the price swing, but not, it would not be something that is dictated by physical factors. It is dictated by price movements. Sure. So this has a unique feature where the facilities are rated for a certain amount. They call that the nameplate capacity. And the way that they were designed is that for periods of time, not permanently, they can exceed that nameplate capacity, hopefully safely, by up to 10%. So that plus or minus 10% swing, as I said, can be very profitable. So if this is rated at, call it 10 shipments a year of LNG, and the price spikes, they can kick it up to 11, and that extra one is free. Then when the price goes down, it'll go back to 10, and they're still honoring all their long-term contracts, and they have that option out to take advantage of the price swings, which gives them something that traders call operating leverage, which is very profitable, and they aren't violating or going afoul of this interp because That ability to produce beyond their nameplate capacity is not something that's part of the contracts they're entering into with their customers. So the forward contracts remain forward contracts, and this other part of their business, which is separate, is not part of that. And you might ask, well, if you have this embedded volumetric optionality as part of your contract and something goes on in the market, can you sell that optionality to someone else? No, because that's part of the original release, is that it has to be a part of the contract that is not severable. You can't peel it off and sell it to somebody else because then you have an option in there that is not part of the contract. So if you have two pieces of the contract that are kind of unrelated and you can peel one off, then it's not really something that you did as part of your obligations as a person in the industry to make and take delivery. It is a trading vehicle, so that would prevent you utilizing this interp as a safe harbor. So if you have any questions, leave them below, and I'll be putting out some more videos soon. Thanks, everyone. Here's my favorite part, the disclaimer. I'm a lawyer, but I'm not your lawyer. Anything you see on here is for educational and informational purposes only. If you have a specific question about your specific circumstances, seek your own legal counsel for those questions. Nothing here creates an attorney-client relationship between me and you. I am not your lawyer. Okay, got it? Have a great day, everyone.